The point behind it is that the rates will be set by the market, not by the central banks. I mean, there's no doubt that what the central banks want to do is to get rates down. I mean, if the Fed could somehow manage rates lower and at the same time fund the US government deficit, then they will be very cheerful about everything. But the reality is they can't get rates down. Why? Because the market is telling them, you've got a debt problem. And that is actually going to set the whole thing. There are two basic drivers of interest rates. The first is the foreigner's view of your currency, and that is desperately important. And that is what we have been concentrating on when we talk about, is dollars going down rather than gold going up. And the second is that when banks turn cautious, then they will only lend at higher rates if they lend at all. The problem the banks have, specifically this time round, I mean, it's a fluctuation that happens as part of the lending cycle. It's a 10-year lending cycle, which you can trace all the way back to whenever statistics were sort of semi-reliable. But basically, the banking systems are over-leveraged compared with where they would like to be. I mean, typically, many of the G-SIBs, the global systemically important banks in Japan and also in Europe, are up to 20 times leveraged. By that, I mean the relationship between total assets to equity. Now, that sort of leverage basically means that it doesn't take very much in the way of losses on your balance sheet to wipe out your equity. And of course, this is a topic which American investors have been made very much aware of with the commercial real estate situation, where values have collapsed and banks have outstanding loans, and they've got, they were lending as if it was a normal mortgage, sort of 80% loan to value type deal. Yet the values have collapsed to 30-40% of what they were. So banks have got huge potential losses, which they're finding extremely difficult to deal with. That is, so they're not in the business of lending money cheaply anymore. Yet they realize that if you get higher interest rates, then the zombified economies, these zombie companies are going to go bust. And even at anything a little lower than current rates, that is a process which is ongoing. This is that, we're going to find more and more businesses going bankrupt at anything like these levels. I mean, it's possible that the Fed might be able to lower rates by 0.25% or something like that, but I very much doubt it they'd even achieve that. And I would have thought that if they tried to do that, then the consequences would be even higher rates down the road. I mean, the idea that inflation is over, and which is the common story in the investment community throughout the world. I mean, it's a joke. Of course, it's not over. The idea that the purchasing power of the dollar, sterling, euro, whatever, is going to stabilize when governments are running massive deficits. In other words, there is more and more currency being created, diluting the purchasing power of existing currency. And then on top of that, you've got the subjective value placed on currencies in this situation by foreigners. I mean, there's only one way for this to go. I mean, and it's not good.
The crux of the matter is that interest rates are increasingly being set by the market rather than central banks. While central banks might wish to manage rates lower and simultaneously fund government deficits, the reality is starkly different. The market, influenced by the perception of debt problems, dictates these rates. Central banks face a conundrum. They can't get rates down because the market is signaling a serious debt issue. This scenario is becoming more evident as central banks struggle to control the economic narrative in a world driven by market forces and investor sentiment. One of the primary drivers of interest rates is the foreign perception of a currency. This factor is critical, and we often discuss the declining value of the dollar rather than the rising value of gold. Additionally, banks are becoming more cautious, lending at higher rates if they lend at all. This caution is compounded by the over-leveraged state of many global, systemically important banks, GSIBs, in regions like Japan and Europe, where leverage ratios can be as high as 20:1. Such high leverage means that even minor losses can wipe out a bank's equity, creating a precarious situation that threatens financial stability. For example, the commercial real estate market in the US has seen values plummet to 30–40% of their previous worth, leaving banks with significant potential losses. As a result, banks are not in the business of lending cheaply anymore. High interest rates spell trouble for zombie companies, businesses that can barely cover their interest payments. Even at slightly lower rates, these companies are likely to go bust, a process already underway. This scenario underscores the fragility of our financial system and the challenges faced by businesses operating on the edge of solvency. Despite some optimistic views in the investment community, the idea that inflation is over is laughable. Massive government deficits mean more currency creation, diluting the purchasing power of existing currency. When foreign investors perceive this, they often devalue the currency, exacerbating the problem. Inflation remains a significant concern, and its impact on purchasing power cannot be understated. As governments continue to run substantial deficits, the long-term stability of our currencies comes into question, prompting investors to seek safer alternatives. The situation becomes even more complex when we look at China. The Chinese government, along with its partners in the Shanghai Cooperation Organization and BRICS, aims to reduce their reliance on the dollar for trade. Chinese nationals can only hedge their currency risk through gold and silver. With household savings at 35% of China's GDP, the demand for gold is driving prices higher. This trend is evident in the rising speculative interest on the Shanghai Futures Exchange and withdrawals from the Shanghai Gold Exchange. The growing demand for gold in China reflects a strategic shift in investment preferences, highlighting the country's efforts to safeguard its economic future. Interestingly, Chinese individuals are not necessarily buying gold because they foresee a decline in the dollar. They are buying gold because they see it as a more stable investment compared to other assets. This growing demand for gold could lead to a crisis in Western capital markets, where gold and silver are often traded as paper equivalents. Physical gold and silver are leaving the West, moving to countries like China and Russia. This migration of precious metals signals a shift in global economic power and raises questions about the future availability of these critical assets in Western markets. For investors, the message is clear. Physical gold and silver are not just safe havens, but essential components of a diversified portfolio. The current financial landscape, marked by high debt levels and cautious lending practices, suggests that gold and silver will continue to rise in value. As Alasdair Macleod emphasized, this is not merely about the decline of the dollar, but about the increasing recognition of gold's value. The ongoing geopolitical shifts and economic uncertainties further underscore the importance of holding physical assets that retain their value over time.
Now, if we look at the Chinese situation in particular, we can add two further layers onto the problem. The one is the determination of China and its partners in the Shanghai Cooperation Organization and also BRICS to do away with using the dollar or depending on the dollar for their trade. The trade between them, the purchases of commodities, let's say within their club, their sphere of influence, they want to do away with that. So that's the first thing about it. Chinese nationals cannot hedge out of the Chinese yuan through any other mechanism other than buying gold and silver. Now, this is important because household savings are reckoned to be 35% of China's gross domestic product. And particularly when you see the gold price being firm, when you see the demand for gold, not just through these banks, but also through deliveries or what they call withdrawals from the Shanghai Gold Exchange, and also growing speculative interest on the Shanghai Futures Exchange, you can see that as far as the entire financial system in China, that is now angled towards gold prices, which are going to go higher and higher and higher, driven by this mountain of accumulated household savings, which sees gold as the way of getting out of their own currency. I think it would be wrong to say that Chinese individuals are buying gold because they see the dollar going down. They're buying gold because they see gold going up relative to other investments. I think there is a distinct possibility that this could lead to a crisis in Western capital markets, because when we deal in gold and silver, we are dealing predominantly in paper equivalents, which in theory are deliverable at the end of the day in gold or silver. But all the physical stuff is basically walking out of the door. I mean, you just look at the deliveries on COMEX. Virtually every day there are contracts stood for delivery, and we're talking about substantial quantities. Gold is also leaching out of London. It's more difficult to actually sort of, if you like, track the numbers there. But we just do know that all this gold and silver is just going out of the door, and it's no longer in our vaults. So where does that leave us? It leaves us with a huge, great problem. So there is a shortage of gold in official vaults in the West, which is unaccounted for. Meanwhile, it's all gone over to China and increasingly Russia, which started in this game only really at the time of the special operation in Ukraine and sanctions. At that stage, they stopped selling gold into the London market. All this gold is just going out. It's just flying away from us. And why? Well, at the end of the day, it's because the majority of the world by population, or the central banks representing the majority of the world by population, is really dumping our currencies. This is a very serious point, which, of course, we don't really fully appreciate, but we will discover to our cost. We will wake up one morning and suddenly realize what the hell's happened.
As physical gold continues to flow out of Western vaults and into the hands of China and Russia, the implications for Western economies are significant. This shift is driven by a loss of confidence in Western currencies and a growing recognition of gold's enduring value. The consequences of this migration are profound, affecting not only financial markets, but also geopolitical dynamics. One humorous tweet encapsulated the situation perfectly. Why did the dollar go to therapy? Because it has a serious value problem. Jokes aside, the reality is that the dollar, along with other Western currencies, is losing its purchasing power at an alarming rate. This is not just a problem for the US, but for all its allies who depend on the dollar for international trade. The declining value of Western currencies highlights the need for alternative assets that can preserve wealth in times of economic uncertainty. The Chinese strategy is clear: reduce dependency on the dollar and increase holdings of gold. This strategy is not only about financial security, but also about gaining a geopolitical edge. By accumulating gold, China is positioning itself as a more stable and reliable economic partner. This move is supported by data showing increased gold purchases by Chinese and Russian central banks. According to the World Gold Council, central bank gold buying surged by 74% in 2023, with China and Russia leading the charge. This trend indicates a strategic realignment in global finance, with significant implications for Western economies. In Western markets, the reliance on paper gold, contracts that are supposed to be backed by physical gold, poses a risk. As physical gold moves east, the ability to honor these contracts with actual gold diminishes. This situation is akin to a game of musical chairs. When the music stops, not everyone will find a seat. Investors holding paper gold might find themselves at a disadvantage if physical gold becomes scarce, highlighting the importance of holding tangible assets. For investors, the message is clear: Physical gold and silver are not just safe havens, but essential components of a diversified portfolio. The current financial landscape, marked by high debt levels and cautious lending practices, suggests that gold and silver will continue to rise in value. As Alasdair Macleod emphasized, this is not merely about the decline of the dollar, but about the increasing recognition of gold's value. The ongoing geopolitical shifts and economic uncertainties further underscore the importance of holding physical assets that retain their value over time. A recent article in the Financial Times highlighted that gold has emerged as a favorite among investors seeking stability in uncertain times. The piece noted that as more investors turn to gold, its price is expected to continue its upward trajectory. This trend reflects a growing awareness of the limitations of fiat currencies and the enduring appeal of gold as a store of value. The movement of physical gold to Eastern countries underscores the strategic importance of this precious metal in global finance. For those in the West, the takeaway is to be proactive. Diversifying investments, and including physical gold and silver, can provide a hedge against the uncertainties posed by high leverage in the banking sector and volatile interest rates. Moreover, understanding the global shift towards gold can offer insights into future market movements. By recognizing the strategic moves made by countries like China and Russia, investors can better position themselves to navigate the evolving financial landscape and protect their wealth. The situation is particularly acute in the United States, where commercial real estate values have plummeted, leading to potential losses for banks with outstanding loans. This decline in real estate values highlights the broader economic challenges facing the U.S. and underscores the need for strategic investment in stable assets like gold and silver. For American and allied viewers, it is crucial to recognize the strategic importance of holding physical gold and silver. As central banks in China and Russia accumulate these precious metals, their currencies and economies gain stability. By incorporating gold and silver into your investment strategy, you not only protect your wealth, but also align yourself with a global trend towards financial security. Remember, in times of economic uncertainty, those who hold gold and silver hold a form of financial insurance that transcends borders and currencies. So, don't wait for the next financial crisis to realize the value of these timeless assets. Invest in gold and silver today.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today. Link in the description.